Hey everybody, this is Greg Gossett, and today is October 15th, Saturday, 2022. How are you doing? Appreciate you being here, and welcome to another edition of the weekly edition of the Gossett Trading and Mentoring Podcast. So, wow, what a week we have had. My gosh, these markets, I've been trading a long time, and I have seen this in 2000 to 2002. I saw it in 2008, 2009, but boy, does it bring back memories of these big moves down. We have a lot of stuff going on with geopolitical issues, rising interest rates, strong dollar. It seems like a perfect storm, doesn't it, to the market? So we'll go through all of this today on the podcast, and I'm actually going to go through all of the indexes this podcast as well, just point out some interesting things that I'm seeing. But basically the format for today is first of all, we are going to run the US legal disclaimer. Secondly, we're going to come back, we're going to take a look at my current positions, talk about why I bought them, when I bought them, and most importantly, how I am going to manage them going forward. I did add a new weekly trade on IWM on Wednesday as well. Then after we go through my current positions and what's going on with them, we're going to talk a little bit about trader psychology. Always most important skill in trading, the ability to create a plan and follow the plan and not let your emotions or the market get your emotions amplified to get you off of your plan. So we'll talk a little bit about trader psychology. Then we're going to do a little poem from my good friend Frank, the trading poet. Always writes great poems, really quick, really nice, always pertinent to what's going on. We're going to do that. Then I have gone down through my entire watch list on the daily and the weekly. There's some interesting weekly trades potentially going on, and I only do this podcast on Saturdays, so I just wanted to point out what I'm looking for next weekend for Friday, because there are some really interesting trades. There's actually more potential interesting trades going on the weekly than the daily. So we'll look at my potential daily trades for next week. We'll look at my potential weekly trades that would happen Friday of next week as well. All right. And then after that, to end off the podcast, we're going to look at all the indexes. Well, not all of them, but we're going to look at the Dow and the SPY, the Qs, IWM. We'll take a look at the dollar, look for kind of some big picture things going on. But I think there's some interesting technical developments happening, especially with the sell-off and the rally that we had on Thursday with the CPI number. Some very interesting technical formations, volume, things like that. I'm going to go out on a limb here, and I believe we are in a bottoming process. Yes, there's all this bad news, but the thing is, the market knows about all this bad news. It's priced in. Unless we have a new development, I think we have a bottoming process going in. But of course, I always want to stick with my levels. I always want to stick with my stops and so forth. But there are some developments happening here where I do think some seasonality as well that I do think put the favor a little bit back into the bull's corner, barring some type of large, big, barring some kind of news that comes out that would give us another leg down. So I hope you're staying safe out there. It is a very, very difficult market to trade. Everyone's so bearish, but there is a lot of opportunity here as well, right? With risk comes opportunity. So we'll talk about all this. Let's go ahead and start the US legal disclaimer, and I'll be back in 40 seconds. Thanks so much. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All right, thanks for holding through that with me. Let's start with TLT. So I did buy TLT back here on the 10th of October. We had an under 30, over 30. That was my entry signal. Bought that at 99.29. Next couple days, it did rally nicely, just right on up. Did take some profits here. I took a partial 10% of my total position size here. Whenever the price moves 0.45 ATRs, which is the reading right here, from the previous day's close, I take 10%. I like to play offense and defense with my trading. Defense is obviously the stop losses, my emergency stop, my end of day stop. But offense is selling into strength. And therefore, if it moves up and then it comes back down and gets below your entry price, then at least I've helped mitigate the loss down. And it's a big part of my trading, taking partial profits, not all, but taking partial profits as the market moves in your favor. So anyway, line down here, that's my 2 ATR emergency stop. That happens on all of my trades. Whenever I take a trade, I take 1% of my total capital. It's a good rule of thumb anyway, 1%. So let's just go ahead and do this. Let's just say you have a $100,000 account. 1% of that is $1,000, $1,000. Now, if you have a $50,000 account, 1% would be 500. $25,000 account, 1% would be 250, right? Let's just use a hypothetical $100,000 account, 1%. $1,000 divided by the 2 ATR over here, $4.09 divided by 4.09. If that were the case, that would tell me to buy 244 shares, because if 244 shares moves $4.09 to the downside, how much is that? It's $1,000, right? Not fun to lose, but it's only 1% of your capital, right? But I always have two stops, the emergency stop and then the end of day stop. Well, why did I take the trade? I took the trade because we had an under 30, over 30. That's my signal to get in. Therefore, if it closes under the 30 RSI, I would get out. About 95% of the time, I'm going to hit my end of day stop, not my emergency stop. The emergency stop's worst case scenario, and I usually make, the majority of the time, I make my buying and selling decisions for my swings at the end of the day, because at the end of the day, the large financial institutions make their final decisions. I feel like they're the smartest money. They have the best information, best technology, very smart people. And so the end of the day close is the most important price and level for me. So did buy here at 99.29. It's currently 98.57. It is underwater. A little bit, about 0.69%. My stop, both of my stops are still in place, have not hit my emergency stop, and the RSI level is 30.72, so it has not closed under the 30 RSI. So I am down on this trade. I have position size correctly for this. In the worst case scenario, if it hits my 2 ATR stop down here, my emergency stop, I will get out. And if it hits that during the day, I don't wait until the end of the day, because it's just got to my the dollar loss level that I have determined. That's as much as I'm willing to take, regardless of whether it's at the end of the day. So anyway, still bullish on TLT. It is down 0.69%. CCL. Okay, I did buy CCL back here on, excuse me, the 11th of October. Why did I buy it? I bought it because we had an under 30, over 30. In addition to that, we have an RSI divergence, and there's a lot of RSI divergences out here, by the way. But look at this previous low back here. Do you see how deep the RSI was? Well, over here on the day that I bought, it's lower than this low. But you see how the RSI level is higher, right? This price is lower than this price, but this RSI level here is lower than the RSI level over here when we're actually lower. So that is called an RSI bullish divergence, and that is one of the reasons that I took this trade in addition to the under 30, over 30 during the day. Now, of course, I always place my emergency stop like we just talked about with TLT, 2 ATRs below my entry. The reason for taking this trade was an under 30, over 30 RSI. Therefore, my end of day stop would be what? it would be a close below the 30 RSI. So there's all sorts of stuff going on here. There, in addition to the Rsi divergence I talked about, there is also a Atr divergence. Here are ATR, here are Keltner channels. You see this low, we got to the third, fourth, fifth ATR to the downside. On this low, even though we were lower, we only got to the -4 ATR. So we have a bullish ATR divergence. We have a bullish RSI divergence, and then we have the trigger, right? The under 30, over 30. Now, I do have this line up here. What is that? That is my trailing stop level. That's 1.5 ATRs above my entry. If it gets there, then I go into another mode. I go into a trailing stop mode. It is not there yet. And, you know, here I'm talking about ATR divergences, RSI divergences, trailing stops, all this kind of stuff. I'll talk about this at the end of the podcast, but I do teach private one-on-one lessons in the evening time, and I teach all 5 of the trading approaches that I've been using for 28 years. It's a great course. I've taught people from all around the world. I've turned out so many good traders, so many good reviews. So, and in this podcast, I do my very best to, you know, point out the things I'm talking about, but I don't really have the time to talk about them in detail. So in my course, I do. And I think the best way to learn anything is with a one-on-one instructor, your coach or your mentor. And that's why I provide these lessons. So I'll talk more about that at the end. Okay, so Carnival, here we go. Bought on the 11th of October at $6.66. Next day moved up nicely, had a nice big move up. What did I do? I hit 2 profit targets on that day. So 2.45 ATRs for my entry. It went up 0.9. Therefore, I took off 20% of my initial position because the market moved my way. Now, if it moves back down, and it certainly could, I could turn this into a losing trade, but it will be less of a losing trade because of the profits that I took on that bar. Regret minimization trading technique is how I like to, or how it's been described. So anyway, moved up, took some profits. It's at a 39.27 RSI. Obviously, it has not hit my emergency stop. It has not closed below the 30 RSI. We had the big move up, then a couple sideways days. It was nice that it was up on Friday with the market going down. So far, this trade up 6.31%, and I'm very grateful for that. UNG. All right. So I have had, well, let's see, 1, 2, 3, 4, 5. I have had 2 trades on UNG. I did take a trade back here on the 3rd of October at 22.39. Next day had a big move up, took some partial profits, right? Next day up again, took some more partial profits. Then here on the 10th, it closed below the 200-day moving average. That's why I took the trade, and therefore I had to get out of the trade for a small gain. Hardly enough to even mention here, but it was a small gain, and it certainly was a small gain, or it certainly was a gain on the trade because I took profits as it moved back up. The rest of the position that I had when it closed below the 200 was not the same position when I took it because I took partial profits off here, but even the remaining amount was slightly positive. Now, I was looking for another trade on UNG with another close above the 200-day moving average, and I did take that on Thursday, the 13th of October, when it closed below the 200 and then above the 200. So that was my new trade. I've traded UNG twice, but that was my new trade. Place my emergency stop down here. You can see that. How far? 2 ATRs below my entry. Then on Friday, with the market sell-off, we had a close below the 200-day moving average, and I had to get out for a loss of 3.26%. So the first trade, slightly positive. The second trade, not so positive. But the reason I also took the trade on Thursday, in addition to the close under 200, over 200, see how the MACD crossed over, showing that there was some positive momentum to the upside. That is also a reason I took the trade. And I always like to have confluences, combinations of different indicators going on. It increases the chance of you having a profitable trade, although this one didn't work out and I had to get out. Now, if it closes back above the 200 again, could potentially take another trade on UNG. All right, had a new trade on Friday on the weeklies. And like I said at the beginning of the podcast, there are some potential day swings that I'm interested in next week, but we are in a location on a weekly where I think it looks very attractive, and that is why I took this trade. However, if we go down next week, there are some additional levels that are close that would be interesting for a trade from me on another weekly for next week. But here we go. Why did I buy IWM on Friday? Well, Friday is the last day of the week, so that's the last day of the bar. Well, you can see here is the 300-day moving average, or the 300-week moving average. We have been kind of holding this level. A couple weeks ago, we closed below, closed above. That would have been a legitimate entry signal. Did not take that trade, but I did take the trade on Friday on this weekly because we went below the 300-week moving average and close back above. So I did get long here, 167.19. Here's my emergency stop, 2 ATRs below. Here's my trailing stop level. And you might say, Greg, wow, that's a huge trade to have for a whole week. Well, it is from a range standpoint, but that's why I always talk about position sizing based upon the time frame and the volatility. Well, look, I'm still, our hypothetical $1,000 loss, it's still the case, even though I'm doing it on the weekly. If we take $1,000, right, remember the premise was $100,000 hypothetical $100,000 trading account, 1% of that is $1,000. $1,000 divided by the value of the 2 ATR on the weekly, $20.92, divided by $20.92. You can see right here's the 2 ATR. It's telling me to buy 47.8 shares. I'm just going to round that up to 48 shares. If I have 48 shares and it moves $20.92 to the downside, how much is that? That's $1,000, right? Because we just did the division. So even though it's a longer time frame, I just buy fewer shares, right? It's telling me to essentially buy 48 shares. Just for comparison's sake, if I were to have bought IWM using the 2 ATR on the daily, 1,000 divided by 1054, it would have me almost buy twice as many shares because the time frame is shorter, right? So whether it's a monthly trade, a weekly trade, a daily trade, that's why using the 2 ATR works so well, because you come up with your maximum allowed loss, and it's going to be the same whether it's a long time frame or a short time frame. So anyway, I did buy this here with the rejection of the 300-day moving average. In addition to that, we have a double bottom and a bullish divergence. Here we have a low, deep red MACD bars. These are momentum bars showing there's a lot of momentum to the downside. Then we rallied into some green, and now we are back at the lows. We have red, but it's not as deep as these other deep red bars down here, showing that they're essentially what this means, the double bottoms bullish divergence, are showing that the selling momentum, even though it looks strong, is starting to wane compared to the first move down, and therefore the implication is we're running out of sellers and potentially moving up. I studied one-on-one with Dr. Alexander Elder. He loves double bottoms bullish divergence, double tops bearish divergences. He thinks this is one of the strongest technical trading indicators out there, and I would have to agree with him, but they don't happen all the time, but they are happening now on this weekly. So again, back to the trade, back to the IWM trade, had an intra-week rejection, went below the 300, went back above the 300. My end of week stop on this is going to be what? Well, I took it because it closed back above the 300 on the weekly. Next week, if it closes below, I just have to get out. That's my end of week stop. And of course, if it gets down to my emergency stop, whether that's Tuesday 1 minute after the market opens, or that's Friday 1 minute before the market closes, or any place in between. If it gets down here, I am going to just get out, follow my rules and get out and take my $1,000 loss. Of course, I hope it moves up, right? Of course, that's why I got bullish on the trade. But next week, if it does close below this 300-week moving average, I just get out of the trade. All right, so let's head over, do a little trader psychology. This is from my very good friend Steve Burns. You can follow Steve at @SJosephBurns over on Twitter. Steve's had a huge effect on my trading. I studied one-on-one with him over a couple years. He has such a great website, newtraderu.com, where he has courses, where he has updates, analysis. It's a great website, newtraderu, and just you, as in the letter U.com. And really want to thank Steve for everything he has taught me over the years. He's a great, exceptional trader and author, and definitely consider him a friend. Let's see what Steve has to say here. Emotions and the ego should never influence your trade size. Only math is a good risk manager. Oh, it's so true. It's true all the time, and especially now with this volatility. That is why I'm such a big proponent of using the 2 ATR, because it takes into account volatility, and it takes into account the movement and the ranges of what's going on at the moment to give you a good sense of how to position size. But look, you can have an ego, right? And emotions. I certainly have them. But the key is to separate yourself from those and your biases and use math as your risk manager. And that's why using the 2 ATR with taking into account the ranges and the volatility of the market is such a good trading partner to have, because if you do that, you'll always only hit your emergency stop. But he is so true. Emotions and the ego should never influence your trade size. Only math is a good risk manager. So, if you have any questions on the 2 ATRs with position sizing, I think position sizing is the most important thing in trading, honestly. Yes, your setups and your stops and all, that's all great. But if you buy too large of a position, man, that's where you get in trouble, right? You could have the best entry signal, but you can still be wrong. And if you go, oh, this is the best entry signal, I am loading up. Well, maybe if you take that trade 100 times, it's going to work out okay. You'll have more winners than losers, but any one particular time doesn't mean that you're going to have a profitable trade. It's just like having pocket aces if you play poker. Yeah, it's the best hand, but how many times I've lost with pocket aces, right? And it's the same with trading. So please take my advice, keep your emotions, or take Steve's advice, keep your emotions and your ego outside of the trade. Doesn't mean you can't have them, but when it comes to taking the trade, for God's sake, please position size correctly, and especially in this market. So remember, Steve and myself are telling you that position size is hugely important, and that's why I use the 2 ATR. All right, before we start looking or turning our attention to the charts, let's quickly go over a poem here from my good friend Frank. Frank is a great poet. He's a great trader. He's a great musician. He's a great journalist, and you can follow him at FrancoD on Twitter. And let's read the poem for today. Behold the market in all its might, in one fell swoop, climbing like a kite. When stocks explode like a rocket in flight, traders fasten their seatbelt, dig in, and hang tight. Well, it would be nice if we had the stocks climbing like a kite, right? And who knows? They might. Like I said, there are some developments technically that have definitely caught my eye that make me think that we could potentially start having a leg up here. Hard to know. I could be wrong. I'm wrong a lot, but we'll go through that in the charts. Let's read one more time. Behold the market in all its might, in one fell swoop, climbing like a kite, or falling like a lead brick. When stocks explode like a rocket in flight, traders fasten their seatbelt, dig in, and hang tight. Well, I hope this is the case. I hope we do start climbing like a kite. We shall see. And but I appreciate the poem, Frank, and please follow Frank at FrankOD over on Twitter. All right, so I have gone through the daily. I've gone through my entire watch list. I've gone through the dailies. I've gone through the weeklies. I don't have a lot here on the daily, but I am going to share with you what I am looking for next week on the dailies, and then we'll switch to look for what I'm looking for next Friday on the weeklies. Did I say that? We'll do the dailies and then the weeklies. First up, Coca-Cola. Let's look on the daily here. So we had the huge move up on Thursday. We had the CPI number that came out in the morning. It was hotter than expected, and we moved down. And then we had this humongous reversal back up. And when I talk about the indexes, I'll get into all the specifics, but we had a huge reversal, which is very bullish, and it came on pretty strong volume as well. And yes, we did have a move back down on Friday, but it came on lower volume, which I think is a good thing, because it showed that the majority of the volume was to the upside, not to the downside. Anyway, on Thursday, we had a V1, and again, V1s, V2s are a setup, an entry signal that I use, an entry technique that I use. And if you'd like to learn more about them, on my YouTube channel under the playlist section, I have an entire video on V1 and V2 entries, and they are really great entry signals. So if you get some time, check out my YouTube channel under the lessons playlist for the V1 and V2 entries. And of course, I teach this in my one-on-one courses as well. So we went under 30 over 30 back on the 11th through the 12th. That was a valid signal. Now, we did come back on Friday. Nothing to buy here. It's still above 33.45. But, if you look at the bottom of this low here, look at the depth of the MACD, the momentum to the downside. Very, very strong. Well, we rallied. We are green now. MACD has crossed over. But if we were to come back down, test this low over here, we still would, depending how fast and how far it came down, but if we, in the next couple days, if we came back down and tested this low, there would probably not even be any red MACD bars. And that's a very bullish setup as far as Dr. Elder goes, because it shows that we had strong selling momentum to the downside. We had a rally, and if we come back down, test this low here, then we're not going to have any MACD bars here most likely. That's called the double bottom with the bullish divergence, which is bullish in itself, but a missing right shoulder, meaning that you've come back down, tested the low, and don't even have any red MACD bars. That's even more bullish. So what I'm looking for next week would be Coca-Cola to come back down, test the lows, go under 30 over 30 on the RSI. That would be my signal. That would be the confluence of signals. Double bottom, bullish divergence, missing right shoulder, retest of the 30, rejection of the 30, and close back above. That's when I talk about having confluence combination of the indicators. Let's look at the weekly. Weekly is down here close to the negative third ATR channel. It's a very good place. It's a very good indicator, especially on the weeklies, to have the prices at near the negative third ATR channel. 92% of the time, when you get down to this negative third ATR channel, you stop going down, move sideways, or move up, which is most importantly. Yes, there are times where you can just move back down through that as well, but statistically, more times than not, when you get near this negative third ATR channel. So we're not quite there yet. I do like the weekly in general because we're close to the negative third ATR channel. On the daily, again, we have a low here, we have a rally, we have the potential to come back down here, test this low, giving us a double bottom bullish divergence, missing right shoulder, and another under 30 over 30. So that's the big picture, looking at the weekly, looking at the MACD divergence. But the real entry trigger for me would be, again, an under 30 over 30 on Coca-Cola sometime next week. Meta. Well, Meta course, Thursday we had the big move up. I think this move is significant. I really do. And when we get to the indexes, I'll go into detail of why I think that is the case. But look, here we have another double bottom bullish divergence. Here we have a low. Here's our low. Deep red MACD bars, strong momentum to the downside. We did rally into some green. And now we are lower than over here, but look at the MACD reading. You can see, yes, there are red bars, but they are not even close to as deep as these red bars. Plus, we had the big, huge bullish engulfing bar reversal on Thursday and a V1. See how we rejected the negative third ATR channel? Boom, right back up. This pullback does not concern me, honestly. You know, when you have huge reversal moves up like that, it's normal to get a little bit of backfill. But look at the volume on Friday compared to the up volume on Thursday, right? Not a lot of people participating in this move down. We also held halfway of the washout bar of on the V1 washout bar that happened on Thursday. That is a positive sign. So with all that said, how am I interested in playing this? Well, 3169 RSI. So the real signal came on Thursday, the under 30 over 30. But here now Friday's move back down, the backfill back down, we're at 3169. So again, we have the double bottom in place. Let's check the weekly. Weekly getting close to the negative third ATR channel. Not as great. I'd like it a little bit closer, but if we move back down and go under 30 over 30, we might get there if we do. But just to sum up, on Meta, I am looking for an under 30 over 30 for next week as a new entry trigger in conjunction with what's going on here with the double bottoms, bullish divergences. Again, we also have MACD, RSI, and ATR divergences. Look here. Here's an ATR divergence. At this low, we were about negative 3.5 ATRs. Now, this low down here, which is much, much lower, we only got to negative third ATR. So that's an ATR divergence. We also have an RSI divergence where we have this low here, RSI reading down here, this low much lower, and the RSI reading was higher. So we have the trifecta here. We have double bottom with a bullish divergence on the MACD. We have a ATR divergence from the ATRs, and we also have a RSI divergence. A lot of divergences going on there. What does that really mean? It just means that the pace and the momentum of this down move, even though it's horrific, was not as strong as the other down moves prior. And the implication is you're running out of sellers, you're running out of selling momentum, and the implication is that we would be going up. And that is how I feel, actually. But that's my theory, that's my outlook, that's my bias, but I still have to wait for the proper signals to validate what my thinking is and what my biases is. So for next week, again, just to sum up, I'm looking for another under 30 over 30 on Meta. Next on board is Nvidia. Well, Nvidia is interesting. Let's compare this to Meta. Meta, we have a low, deep red MACD bars, we rally into green. Now, then we make a lower low on Meta. There are some red bars here, but still a double bottom with the bullish divergence. Now, key point is low with red, next low with red. But look at Nvidia. Nvidia, we have a low in the past with very, very deep red MACD bars, right? You can see these down here. Then we rally into some green. Now we're lower, but you remember how Meta had red bars? Well, Nvidia has green bars, so it's different. It's better. It's a double bottom with a bullish divergence with a missing right shoulder. There's no right shoulder of the red. This is the left shoulder of the red, but see how there's no right shoulder here? So that is very, very bullish. And of course, again, on Friday, we had the big move up. We did have some backfill on Thursday, but again, look at the volume on the way up on Thursday. Look at the volume on the way down on Friday, not as much. So we're at a 32.98 RSI. I am looking for an under 30 over 30 again as my entry trigger because of the double bottom, bullish divergence, missing right shoulder. There are also ATR divergences. Look here, we're at the fourth ATR channel here. We are much, much lower, and we're only at the third. Look at the RSI levels. Look at these lows. RSI level down here. We made a lower low. RSI level's not as low. So again, double bottom, bullish divergence, missing right shoulder. That's one divergence. We have an RSI divergence. We have a MACD divergence. So big picture of the structure here, I really like from a technical standpoint. I really like the huge move up that happened on Thursday, obviously, with the confirming volume, and then the move back down on Friday. Yes, unfortunate, but it came on lower volume. So under 30, over 30 is what I'm looking for next week on Nvidia. All right, let's switch over to the weeklies. And like I said, I do have quite a few weeklies that I'm interested in next week. I think there's some real opportunities at these weekly levels, especially because of all the double bottoms, bullish divergences, the action that happened on Thursday as well. Advanced micro devices. Well, I mean, look at this. My gosh, what a huge move down. 1, 2, 3, 4, 5, 6, 7, 8. 3 months of basically straight down. So let's look at this objectively, and here we go. If we look at the weekly, we are at the negative third ATR channel. Remember, 92% of prices when they get to the negative third ATR channel, and even more importantly on the weekend, the weekly than the daily, that's usually where they stop going down, move sideways, or rally. Now, of course, again, it can go below, certainly, but we have to look at the statistics and go most of the time when it gets to this level, that's about it. We are at a 32 RSI level, which is, it's unheard of for AMD on the weekly to get to the 30. Not unheard of, but it does not happen very often. But let's take it all, let's put it all together and see what's going on here. Okay, near a 30 RSI, we are near we actually bounced at the negative third ATR channel. The 300 week moving average here, that is a very important level, and it has held that so far. Okay, so what I'm looking for next week on the weekly would be one of two things. I guess one of three things. First option would be a rejection of the 300 that goes below it and then closes back above. Just exactly like IWM that I took on Friday, or an under 30, over 30, ideally both. We go under 30, close back over 30 on Friday. We go under the 300, close back over the 300 on Friday. That would, and not to mention the negative third ATR channel, that would be a really, really good entry point. Alternatively, if we close above the 200 week moving or 250 week moving average, that would be another potential entry signal for me as well. So the best one would be an under 30, over 30, under the negative 300 week SMA, over the negative 300 week SMA, under the negative third ATR channel, over the negative third ATR channel. If that happens, then I would think that would be a very, very good risk to reward ratio on advanced micro devices. So that's what I am looking for. Dow Jones. Okay, this was a legitimate entry signal on Friday. I decided to go with IWM because it was stronger, relatively stronger than DIA. But you can see, what did we have? We had an intra-week rejection of the 200-day moving average. We went below it, closed right back above it, and we have a V1. Here's day one, or bar one, bar two goes under bar one's low, then closes above bar one's close. This is a completely legitimate entry signal here, but again, I did not take it because I took IWM. But next week, what could I look for? Well, if we head back down, a rejection of the 250-week moving average would also give me a good risk to reward ratio, or a rejection of the 300-week. And boy, we'd have to really move down a lot for that to take place, but it definitely could happen. But this would have been a legitimate entry on Friday. But again, I don't want to take too many on the same day, and I did take IWM. Excuse me. If we look at divergences, Not a great divergence because we have lows over here, which are deep. Yes, we rallied in the green, then we came back down. Ideally, a real good divergence is when the second red bars are only less than half of the first red bars. And I know this can kind of get confusing, but again, that's what I teach in my one-on-one courses, and I'll talk more about that at the close. But there is a divergence here, not a great one, but there is an RSI divergence. See the low we have here? See the reading of the RSI down here right at the 30? Well, we got lower over here on the Dow, and you see how the RSI is not as deep. And there's also a MACD, an ATR divergence. Here we're at this low, we're at the negative third ATR channel. Here we go lower, we're only at the negative 2.25. So there isn't a MACD divergence, not a great one, but there is a nice RSI divergence. There is a nice ATR divergence, and nice, on the weekly, nice formation here with the V1 entry and a close back above the 200. Had I taken this trade, if it would have closed below the 200, I would just get out, and of course I'd have my emergency stop. So I'm just, for DIA next week, I am looking for a rejection of the 250 week moving average, or the 300 week moving average, or an under 30 over 30 as well. Gold. Well, gold has really got smacked up here as well. We have a 35.29 RSI reading. I like this level right here, everyone, right about 150. And from a psychological level, that makes sense as well. Nice round number. But look at the confluence we have here. We have a negative third ATR channel. We have a 250 week moving average. And if we got down there, we'd probably be pretty, depending how far and how fast we do it, we get to the 30 RSI. So on gold, if we went under the 250, over the 250, under the 30, over the 30, under the negative third ATR channel, over the negative third ATR channel, I think that would be an excellent confluence of indicators lining up and a very good entry point for your weekly. Google. Well, look, this is a nice double bottom and bullish divergence. Here we have a low with very deep red MACD bars. You see this? We rally into some green, which is a requirement. Now we are lower than this previous low over here. Do you see how we have red MACD bars, but they are not that deep? They are less than half of these. That's legit. We're at a 37.09. Doesn't mean we can buy it yet, but the big picture setup is set with the double bottom bullish divergences. We also have MACD divergence, or I'm sorry, ATR divergences. Look at this low. We're near the third ATR channel. Look at this low. Lower than that, we're only at the negative 2. Right? Look at the low here on the MACD, on the RSI. Here we're lower, here it's higher. So we have a triple convergence MACD, RSI, ATR divergence here. So what is the signal? Well, the signal would be a bounce, a close below the 200 weekly SMA, close back above, or just simply an intra-week rejection. So I love Google as far as a stock and a company. One of the best ones out there, right? And by the way, we are in a complete clearance sale on stocks right now. If I were you, right? I mean, this is just my personal opinion and what I am doing, but I'm not messing around with little stocks at this point. The best stocks in the world, Google, Apple, the indexes, they're on sale right now. And Dr. Alexander Eller always told me, he's like, everyone loves to buy stuff on sale except for the stocks. They always want to buy full retail for some reason. And honestly, if you go back in time, buying when people are scared has always been the best time to buy, right? I mean, you still have to set your stops and your parameters and your levels. But honestly, I think there's a lot of opportunity down here. Everyone in the media is so bearish. I mean, it's just nonstop, right? Everyone from the Fed, nonstop bearish. But the market, with these divergences and the rally that we had on Thursday, I think that's the truth. I think that's the real truth of the matter, that I think we have a bottom forming at this moment. I could be wrong. I'm wrong about many things, but so back to Google. Any kind of rejection of this 200-week moving average, I am definitely a buyer of Google. Doesn't mean I'm going to be right, but it means it gives me a good risk to reward ratio and a very clean level to work off of. Home Depot. Same thing. Huge double bottom bullish divergence. Look at the bottoms here. Deep red MACDs. Here we have lowers. Very slight MACDs. So the momentum is waning to the downside. I know it doesn't look like it, but from a MACD perspective, it is. I would be looking for some kind of intra-week rejection of the 200-week moving average. That is where I would like to get into Home Depot. Microsoft. Well, again, double bottom bullish divergence, not as strong as the Home Depot one. We rejected the -2 ATR channel. What I'm looking for on the weekly on Microsoft, same as Home Depot. Look at this nice confluence. We have a 200-week moving average. We have a -3rd ATR channel lined up right together. We're at a 35.72 RSI. If we were to go down here, reject that 200-day moving average, we would also most likely, depending how fast and how long it takes, the RSI would probably go under 30, over 30 as well. So on Microsoft, if I could get an under 30, over 30, a rejection of the 200-week moving average, a rejection of the -3rd ATR channel, in my opinion, that would be an excellent place to buy one of the best companies in the world, Microsoft. Nvidia. Now, I know I talked about Nvidia on the daily, but also on the weekly, because we have, again, another double bottom bullish divergence. We have the lows here with the deep red MACD. We rally into green. We come back down. We are lower, far lower, and there is red, but it's less than half of the lowest point of this first MACD move down. We also have, we're at a 30.82 RSI. As a matter of fact, this was a legitimate entry on Friday because it's 38.82. You can see it went lower and then closed back above. I did not buy this because I usually just buy one position at a day, and I bought the weekly IWM as we discussed. But going forward, I would love to be able to buy Nvidia. I mean, Nvidia is one of the best chip companies in the world. It is really taking it on the chin, just like AMD, but I have to wait. And what am I waiting for? Well, look, we're at a 30.82 RSI. If we go under 30, over 30, then that's legitimate entry for me again. Or if we close back above the 250-week moving average, that would also be a legitimate entry. If we move lower and we reject the 300 MA, that would also be a legitimate entry for me. So a rejection of the 300, if we move down, would be legitimate. If we move up and close above the 250, that would be legitimate. Also, if we move up strongly and get above the 200-week moving average, that would also be a legitimate entry for me as well. Or we could just come down under 30, over 30 on the RSI. That would also be legitimate, even if we didn't reject the 300. So we could still stay between the 250 and the 300 here and have a legitimate entry. The Qs. Well. Again, right off the bat, we have a low, deep red MACD. We rally into green. We come back down. We are lower than this previous low, but the MACD does not indicate that the movement was as strong as here. ATR divergences here. Here we're near the -3rd ATR channel. Now we're lower. We're only at the -2. RSI, look at the low here with deep red, the low here with the reading of the RSI way down here. Now we are lower and the RSI is higher. So again, triple divergence going on here with MACD, RSI, ATR. What is the entry signal for me? Well, if we move down, here's the 250-week moving average. If we reject that, then that would be a potential entry for me. If we were to get above the 200-week moving average, that would be another potential entry for me. Or if we just simply have an under 30, over 30, that would also be another entry. The SPY. Well, this again had been a legitimate entry on Friday because we rejected the 200-week moving average and closed above it. If I didn't buy this because I bought IWM, but if I did, how would I do it? Well, I would take my maximum allowed loss divided by the value of the 2 ATR. That would show me how many shares to buy. I would use that same value as my emergency stop. And then my end of day stop would just be a weekly close below the 200. But again, I did not buy this, but IWM, but they're correlated. They're going to move together for sure. But next week on Friday, again, if we have an under 30 over 30, that would be my entry point. If we have a rejection of the 250 week moving average, that would also be my entry point. Walmart. Okay, well, Walmart has been holding up pretty well. It's above the 200-week moving average, which is much better than most stocks. So the relative strength's pretty good here. We're in the value zone. We're holding tight here. If we just had a move back down to the 200-day moving average, that's what I would be looking for. And you can see over here, that same entry signal with the close under, close over, never closed back below the 200 would have been an excellent entry point. And I always like to look and see what moving average held in the past. If you're above it, below it, above it, below it, above it, below it, now you're losing respect for it. But you can see the market did respect the 200-day moving average in the past. Is it going to do it if it comes back down? Well, you can't say for sure, but it's more likely. I can say that. And so if we get a rejection, a close under the 200, over the 200, that would be an interesting spot for me, or an intra-week rejection of the 200 would also give me a good risk-to-reward ratio. Last but not least, financials. Well, nice little formation here. Double bottom, bullish divergence, V1 entry signal, rejection of the 250, rejection of the 200. This would have been legitimate on Friday. Didn't take it again because I bought IWM. But going forward next week, if we come back down, get another retest of the 200 and then close back above, I would like to add the financials. Or if we come back down, reject the 250 here, that would be another potential entry signal, especially in light of the double bottom and the bullish divergence and the RSI divergences and the ATR divergence. So basically what I'm saying, regardless of what stock that we look at or what symbol that we look at, index or stock, there are a lot of bottoming indications here. And I know it's scary as hell. Trust me, I'm scared every day in this market, right? But have to step back from it, look at the signals that are going on here, and it tells me that we are in a bottoming process. Now, something could happen, news-related, headline-driven, something, pension fund in UK, or, something definitely could happen. So I'm not saying for sure 100% we're at the bottom. We could go lower, right? But I'm just saying big picture, it looks to me like there is a bottoming process happening. Okay. Let's take a look at the indexes, and we're also going to look at the dollar, okay? So let's look at the daily on the Qs. Okay. Now, I've been through the double bottoms, bullish divergences, the ATR divergences, the RSI divergences. We had this huge V1 bar on Thursday. And let's talk about that a little bit. So we had the CPI reading. Everyone was, on pins and needles for the CPI, which is Consumer Price Index. It's a measure of inflation, of what's going on, and of course that's the key thing right now, is inflation and the Fed, and that's what's roiling the markets here. But what was really interesting, you've heard the saying, buy the rumor, sell the fact. People say, hey, Microsoft's going to have great earnings, and everyone thinks it's going to have great earnings. And so people bid it up and bid it up and bid it up and bid it up, and it goes higher and higher and higher. And then finally the earnings come out and everyone's, yay, they're good earnings, but then the stock goes down. It's not surprising because people were front running. They were buying the rumor and selling the fact. Okay. It works the opposite way as well. You can short the news, and then when that news event actually comes out, you can cover. It's the exact same thing, just flipped on its head. And I think that's what happened on Thursday. As a matter of fact, Wednesday, I was thinking about it on my hike, and this came to me, and I actually ended up being totally right, which was great. But my thought was, look, The CPI reading is probably going to be high, right? Because it takes about 6 months for these federal interest rate hikes to work itself into the economy. And we've had 3 hikes now, but the first hike is just starting to kick in. So I thought, yes, they've had all these interest rates hikes, but they have not had enough time for the interest rate hikes to actually seep into the system and have the desired effect to help reduce inflation. So when the CPI number came out, I thought, I don't think there's been enough time. I think there's going to be, I think the number still could be high, but I think the key point of this story is my thinking was this is going to be the highest reading because in the future, more time is on the side of the interest rates hike to affect and slow things down. And that's really what the market's looking for. They're looking for peak inflation, right? Doesn't mean that next week or in a couple months now that inflation is going to go back down to 2%. No way, no way. But in a month or 2 months from now, the market could be much higher, even though we have not hit that inflation number that the Fed wants at 2%. But the key is that the CPI numbers in the future are most likely going to be lower than the one that we had on Thursday. And so people were basically selling the news and selling the rumor of a high CPI number and buying the fact of the high CPI number. Essentially saying that was the highest reading we're going to have and therefore the market can move up. So I think that's probably one of the reasons why we had that huge move up. So again, look at the volume on the Qs on the up move. Huge. I mean, look in the past, nothing even close, right? And then yes, we had a big pullback on Friday on lower volume. A pullback is to be expected. People bought down here. As a matter of fact, I bought down here as well. I did buy the open, thankfully, based upon what I just told you as far as what I thought was going on with the buy the rumor, sell the fact, or sell the rumor, buy the fact in this case. But we had a huge bullish engulfing bar here. Look at the little inside bar here. People didn't want to get one way or the other because of the news that came out. But look, we rejected the negative 30 ATR channel. We rejected the 30 RSI. We had a huge bullish engulfing bar that came on huge high volume. If you read How to Make Money in Stocks, William O'Neill, when he talks about finding bottoms, one of his main criteria is that you have to have a reversal bar near lows, extreme readings. You have to have a reversal bar that comes with the volume being twice the previous day's down bar. Well, this was certainly twice, right? So this looks bullish to me. I barring some kind of new event, I think the bottom is in. I'll go out on a limb and say I think the bottom is in at this point. Again, I could be completely wrong, but from a technical standpoint and the volume that happened, I think we have a bottom in unless we have some unexpected news, which of course could take us to new lows, the divergences, the ATR divergences, all sorts of technical stuff going on. And the volume speaks volumes to me on the way down. Now, the one thing I don't like about the Qs, and my students will know this, here we have a V1, a stop. If you have a V1 entry trigger, from a Fibonacci standpoint, a close below halfway of this bar here is concerning. And the Qs did close below halfway. Now, the SPY, IWM, diamonds did not because they have been stronger, relatively speaking, than the Qs because the Qs are more tech is more susceptible to higher interest rates. And that's why Qs at this moment are lagging. So anyway, that's my take on what happened with the inflation number on Thursday. Not surprised that we came back down. Love the idea that there was only low volume here, but this looks very bottomy to me. All right, let's go to SPY. SPY. All right, well, SPY, same thing, double bottom, bullish divergence, ATR divergences, RSI divergences, MACD divergences, huge big up move on huge volume on Thursday, Came down. Yes, it did, but look at the volume. Very, very low. MACD is positive. Do you notice that? MACD is actually positive right now. I think that's a very good sign. And the SPY also held halfway of Thursday's washout bar. So interesting there. Love the low volume, love the huge reversal, but this is significant. Not only did we have the V1 bullish engulfing bar, we also undercut this previous low here, and it's still holding. Diamonds. Diamonds the strongest, for sure. Same thing, double bottom, bullish divergence, huge move up, huge volume, really low volume on the pullback, held halfway, actually got above here, which technically changes market structure. So this looks very bullish to me. IWM, also very strong. Double bottom, bullish divergence, big bar on Thursday. Yes, pull back here. And again, I did buy this on Friday, but I bought it on the weeklies, not on the dailies. I like to have different trades. I like to have different time frames. Lately, I've had a lot of trades just on the dailies, but I was glad to get a weekly trade in there as well. I think it helps even out your equity curve using trading different time frames, intraday, dailies, weeklies, monthlies, and then also trading different trading approaches as well with as many different types of industries and markets as possible as well. All right. And then UUP. UUP is the dollar. And everything that's happening right now is happening really circling around the dollar and the dollar strength. When you have this much strength, it makes it very hard for people in other countries to buy U.S. goods because the dollar is so strong, makes them have to buy dollars. There's been some liquidity issues with banks and other companies and financial institutions in other parts of the world scrambling to buy dollars. So really, it has to do with bonds, it has to do with dollars. But I want to show you something here on the dollar, which may dovetail into my bullish scenario for stocks. Well, look, here we have a huge down bar. Whenever you have a huge down bar, if you rally back up to about halfway of that bar, that's going to act as resistance from a Fibonacci standpoint. Well, we had the huge move up, then we had the huge move down. Here's halfway of the bar. You see how we got right to it? We tested it a couple times and then came back down. And then look where then dollar again was up again on Friday. But you see how we're still at the halfway. This resistance is holding, which is good, because if you're a bull right now, you need the dollar to go down, because if the dollar goes down, that means interest rates are going down as well, and the market is really looking for the dollar to stop going up. The more the dollar goes up, the more the market goes down. That's really all there is. But you can see this level has been resistance here and here. We got above it intraday and then came back down in here and here again. And the big down move that we had on Thursday on the dollar, and again, if you're a bull, that's what you want. You want the dollar to go down. Look, significant volume to the downside. We did rally back on Friday, yes, but look, the rally came on lower volume. So anyway, just wanted to show you that. That is an important thing to watch as far watching the dollar as far as what's happening with the stock market. So all in all, from a technical standpoint, things look like they're bottoming to me. The rally that we had on Thursday was incredible. One of the biggest reversal bars ever that came on a huge amount of volume. And then also, my hypothesis of that, I think the CPI reading, this last report, was probably the highest reading that we're going to have. I could be wrong, but that is my hypothesis, and it did play out on Thursday. And if we have a peak number, then if the numbers in the future are lower and lower because the interest rates that have been added are catching up and will filter their way into the system, I think Thursday could have been the bottom unless we have some. Of course, if the CPI comes out and I'm wrong and it's higher, yes, then the market will go lower. But my hypothesis is that the peak inflation is in at this moment, and that's why we had the rally on Thursday. So anyway, I hope this was helpful, everyone. At the beginning of the podcast, I talked about that I teach private one-on-one lessons in the evening time. I do. I love to teach. I've turned out so many great traders, and I just enjoy teaching people how to trade. So I teach a course. It's really great. It's 15 total hours, 5 sessions. Each session is 3 hours. I teach you all 5 of the different trading approaches that I use. I teach you step by step. It's very important to me that my students succeed. Every time I get a new student, I'm like, I'm going to do the best I possibly can for this student because I want them to succeed. And I teach you step by step every single thing I use in my trading. And we get to hang out and spend some time together and get to be friends, and at the same time learning some really good things. So if you're interested, the first step would be just to send me an email. The email is in the link of this YouTube video. Just send me an email, say, hey, Greg, I'm potentially interested in taking your course. I'll write back, say, hey, great, sounds good. How about we do a Skype call? Skype call is free. It's not a sales call. I promise you that. I just want to talk to the prospective student, find out about their trading challenges, their goals. It's a great time for them to ask me any specific questions about the course. And then when we're done with the call, I promise you, that's it. It's up to you at that point. And when we're done, if you decide one day, hey, today's the day I do want to learn this from Greg, just write me back and we'll set up the course in the evening time, and we'll do it one-on-one on Skype. And it does cost $1,750, but I promise you it's the best $1,750 you'll ever spend if you're serious about trading. Secondly, if you like online courses, I have a great online course available at udemy.com. The link is also in the description of this YouTube video. I teach you the step-by-step how to trade the deep dip buy stock trading strategy. And boy, are we in deep dip buy stock trading strategy zone now. I mean, that's all that's going on. I don't see a lot of crossovers or the different other approaches that I teach, but this is a perfect time to take that course. And the course is so valuable. It has 9.5 hours of video. It has 26 videos total. It has 15 study guides. And the best part, it only costs between $12 and $15 on udemy.com. So do yourself a favor, click on that link, take that course. You're going to enjoy it. I've had so many 5-star reviews from all over the world, and so many nice thank yous from people who have taken the course, and that will make you a better trader. I mean, the one-on-one course, of course, is more intensive, and you have me there as well. It's better, right? I mean, it's better, but for the money to learn one process right now, just check out that course on Udemy. And I think you're going to be really glad that you did. 2 more things. Number 3, if you like today's podcast, I would really, really appreciate it if you could hit the thumbs up button and or share it on your social media. It really does help the channel. It helps let YouTube know that there's some valuable content here, and so they can get it out. And boy, I'll tell you what, there are a lot of people that could use some help with trading and some guidance now, and hopefully by them watching this podcast, it will help them out. So if you could do that, I would really super appreciate it. And then last but not least, and the most important thing, please try to go out and do something nice for another human being today. Right? It's just good karma. If it was you would want somebody doing it for you. But I just think it would make the world a better place if you could just do one nice thing for another human being today. Hold the door open, help them if something falls, give them a bite of your donut. I don't know, whatever, but just something nice. And it would be extra good if, in addition to helping the human, you could also do something nice for an animal as well. But those are my 2 goals every day. Do something nice, go out of my way, do something nice for another human being. Go out of my way, do something nice for an animal, because both humans and animals do appreciate acts of kindness. So that's the most important thing about this whole podcast today. So I hope you have a good weekend. I hope you enjoy. I hope you stick with your trading plans next week. Yes, it's scary out there. Boy, you read any headline, you just think the world's going to fall apart, and who knows, maybe it will, but hopefully it doesn't. And I do see some good bottoming signs here. Doesn't mean we're at the bottom right this second, but Thursday's rally was significant to me technically and from the volume. So let's keep our minds open to what happens next week, and hopefully coming into the end of the year here from a seasonal standpoint, the second half of October, October and November, December usually are good times for the market to the bullish side. You know, this is a different kind of year, may not be, but I just like the statistics that we are coming into a bullish phase of the market. So appreciate you being here, everyone. If you have any comments or questions, put them in the comment section. I'll do my very best to get to them. And if you have any questions, do my best to answer those for you as well. So thanks again, everyone. Enjoy the rest of your weekend, and we'll talk to you next week. And on the way out here, I have to run the U.S. legal disclaimer. Take care, everyone. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.